You open your phone, check the price of gold, and once again, it's higher than it was yesterday. The headlines are buzzing, analysts are arguing on television, and suddenly that quiet, old-school metal your grandparents talked about is acting like the star of the financial world again. And then the question hits you. How long can this actually keep going? Because let's be honest, nobody wants to be the person who shows up late to the party and then watches everyone else quietly leave through the back door. Gold has been climbing, confidence has been building, and more investors are starting to pay attention again. But here's the thing most people don't realize right away. Gold rallies rarely end just because the price looks high. Markets don't operate on vibes alone. They move based on deeper forces that are usually invisible if you're only watching the chart. So today, we're going to unpack what actually keeps a gold rally alive, what could slow it down, and most importantly, how to recognize whether we're still early in the move or already closer to the later stages. Now, before we go any further, let's reset one common assumption. Gold does not rise randomly. It doesn't wake up one morning, stretch, and decide it feels bullish. There are specific macroeconomic conditions that tend to act like fuel for the trend, and the biggest fuel source by far is interest rates. More specifically, something called real yields. That sounds technical, but the concept is actually simple. Real yields are basically what you earn from interest after accounting for inflation. If inflation is eating away at your savings faster than your bank account is growing, suddenly holding cash doesn't feel so attractive anymore. Gold doesn't pay interest, but when real yields are low or negative, that disadvantage becomes much less important. Suddenly, holding gold feels less like missing out and more like preserving value. Think of it like comparing two parking spots. One charges you every hour and the other is free. If both spots keep your car equally safe, you're probably choosing the free one. When real yields drop, gold becomes that free parking option in a financial world full of fees. Now here's where things get interesting. We're currently in a global environment where debt levels remain historically high, and central banks have to walk a very delicate line between controlling inflation and keeping economic growth from stalling. That uncertainty tends to be supportive for gold over longer periods because it increases the chances of looser monetary conditions returning at some point. And markets are forward-looking. They don't wait politely for official announcements. They start repositioning as soon as expectations begin to shift. Another powerful force behind gold's strength lately has been central bank buying. And this isn't just a small side note. In recent years, central banks around the world have been accumulating gold reserves at one of the fastest paces in decades. When institutions with extremely long time horizons start consistently buying an asset, that creates a structural demand base. These buyers are not trying to flip a quick profit before lunch. They're thinking in terms of stability, currency diversification, and geopolitical resilience. If you imagine the gold market as a stage performance, retail traders are the crowd reacting emotionally, while central banks are the stage crew quietly reinforcing the structure so the whole thing doesn't collapse mid-show. Their buying doesn't always create dramatic spikes, but it can provide a steady underlying bid that helps support longer-term trends. Of course, gold does not move in isolation. The strength of the US dollar also plays a huge role. Because gold is priced globally in dollars, a stronger dollar can temporarily act like gravity pulling prices down, while a weaker dollar can feel like removing weight from the system. If the dollar strengthens quickly, gold can stall or dip even if the broader long-term thesis hasn't changed. It's less about gold suddenly becoming unattractive and more about currency mechanics shifting the relative price. It's a bit like international travel. If your home currency suddenly loses value, everything abroad feels more expensive overnight, even though the hotel didn't change its price. Now let's zoom out even further and look at history, because one of the most underrated truths about gold is that its bull markets often last much longer than people expect. Between 2001 and 2011, Gold experienced a sustained multi-year rally that wasn't just a quick spike followed by a collapse. It climbed in stages, with pauses, corrections, and periods where sentiment cooled down before continuing higher. These longer cycles often surprise newer investors because we're used to faster-moving markets where everything happens at internet speed. Gold tends to operate on a different rhythm. It's less like a viral trend and more like a slow-burn story that quietly builds momentum over time. But that doesn't mean it will rise forever. Every trend eventually reaches a point where conditions shift. So what could actually stop a gold rally? One of the clearest pressure points would be a sustained rise in real yields. If interest-bearing assets begin offering attractive returns after inflation again, capital can rotate away from gold. Another potential headwind would be a strong, persistent dollar rally. If global liquidity tightens and demand for dollars increases, that can weigh on commodities across the board. And then there's the behavioral side of the market. Toward the later stages of a bull run, gold often becomes extremely popular in mainstream media. You start seeing it discussed everywhere, from financial news to casual dinner conversations, where someone who has never invested before suddenly has a very confident opinion about bullion. That's usually when things start to get a little overheated. Parabolic price moves, heavy retail inflows, and widespread "this time is different" narratives can all signal that a trend is entering a more fragile phase. Markets rarely ring a bell at the top, but they do tend to get loud. Interestingly, we're seeing some of the classic late-cycle signs in certain areas, but not all of them are fully present across the board yet. While interest in gold has definitely surged, especially among retail investors in places like China and on trading platforms, the extreme level of universal retail mania that historically marks the absolute top of major bull markets isn't quite there everywhere. That doesn't mean the rally is guaranteed to continue forever, but the current picture suggests we may still be in the middle to later innings of this bull market rather than the very final moments. For beginners watching all this unfold, the biggest takeaway isn't about guessing the exact month or year when gold might peak. Timing tops perfectly is one of the hardest tasks in all of investing, even for professionals with entire teams and advanced models. What matters more is understanding the forces that sustain trends and recognizing when those forces begin to weaken. Gold's role in a portfolio is also different from assets designed for explosive growth. It's typically used as a store of value, a diversifier, and a hedge against certain macro risks. Expecting it to behave like a high-flying tech stock is like expecting a cargo ship to win a speedboat race. It's built for stability over distance, not sudden bursts. So when you ask how long gold can keep rising, the honest answer is that it depends less on the current price level and more on whether the underlying drivers remain supportive. As long as real yields stay relatively contained, central bank demand persists, and uncertainty around long-term monetary stability continues, the broader trend can remain intact even if short-term volatility appears. Eventually, though, conditions will change. They always do. And when they do, the shift is often gradual rather than sudden. Momentum slows, rallies become less convincing, and new highs become harder to sustain. Watching those transitions with patience is usually more effective than trying to jump in and out based on daily headlines, because markets reward discipline far more consistently than they reward perfectly timed reactions.